What everyone wants to know is what does war, global conflict, do to the markets? Traditionally, typically, when we see big time global conflict, especially if the US is involved or if you've got major superpowers or it can be highly disruptive, you're going to see money pour in from other markets into US Treasury bonds. Because at the end of the day, the US is one of the big dogs, and our 10-year treasuries, any of our treasuries, that's a safe place for money to go. So money shifts to treasuries. When that happens, the price of the treasuries go up and yields go down. Yields go down, rates go down. So war is usually good for interest rates. Usually. Now, here's the problem. We look at the last, a couple conflicts, especially Ukraine and Russia. This was one of the first times where people were like, hey, okay, but shouldn't I have better rates? War is good for rates, right? It's like a pandemic. It should be awesome. Now, because you have the threat of inflation on a global scale, and that's become much more prevalent because these wars that are being fought aren't necessarily, one small country spending a ton of money and resources against another one. They're long, drawn out political conflicts where you're talking hundreds and hundreds of billions of dollars getting spent. People are, traders are having to put a lot more stock into the long-term potential global inflationary reaction of war.